Hi, this is James Nelson from Massey & Ackle Realty. I'd like to present to you our year-end New York City investment sales overview for 20. We're able to put this report together because we have 50 sales agents who cover the New York metro area and contribute to our property sales report that we put out every quarter. As you can see, for all of 2010, we had a big uptick in activity from 2009 to 2010. We ended the year with close to $14.5 billion in trades, which was up substantially from 2009's $6.2 billion, but still far below 2007's $62 billion. As you can see by the pie chart in the upper left-hand corner, the bulk of the sales were from office product, with 45% of those sales accounting for the dollar volume. As far as building count, though, there was a real mix across the various asset classes, with walk-ups and mixed-use apartment buildings having the most activity, with respectively 417 and 316 sales. In fact, walk-ups accounted for 25% of the property volume of sales. As we look at the overall turnover volume, in the height of the market in 07, over 3% of the building stock turned over, whereas in 2010 there was only 1%. Manhattan had the most pickup in activity in 2010 with 473 properties sold. This was a 47% increase over 2009, whereas Queens improved the least. They actually had fewer sales from 2009 to 2010. With dollar volume, Manhattan once again improved the most with a 187% increase, but only 144% when the $1.8 billion Google sale is not included. Queens again improved the least with a slight decrease in activity. Now looking at Manhattan, as far as the total dollar volume, again Manhattan accounted for the bulk of the transactions last year with almost $12 billion out of the total of $14.5 billion. This was a dramatic improvement, as was said previously, over the previous year, and here office properties accounted for over 54% of the activity. As far as the volume in the various asset classes, 1 to 4 families had the most sales with over 109, whereas here in walk-ups and apartment buildings there was only 126 buildings which traded. We saw a big pickup in activity this year with development sites with 41. In 2009 there was only a total of 13 sales. Also, the hotel asset class picked up quite dramatically with 13 sales. In 2009 there was only a handful. Here our turnover was more than citywide, with 1.7% of the property stock turning over, and in the height of the market in 07 we had over 3.5% of the properties. Last year was a big year for institutional size sales. As you can see, in 2009 the largest sale was Worldwide Plaza at only $590 million. In 2009, the top 10 sales accounted for $1.2 billion in trades, whereas in 2010 there was a total of over $6.7 billion, almost 5 times the amount, with the Google sale once again at close to $1.8 billion, and the McGraw-Hill building at over $1 billion, representing 2 significant sales. As far as the price per square foot averages from 2000 to 2010, you can see that the price per foots are pretty consistent, with the overall average actually going down slightly in 2010 to $708 per foot, whereas in 2009 it was $763 a foot. We believe that because there were so few transactions in 2009 that these numbers were skewed. The market was actually a lot healthier in 2010. However, because there was more sales that took place, some of the distressed assets found their way to the market, and as a result, I think that's why you're seeing the pricing dips. As you look at the historical price per square foot, you can see that with walk-ups and elevated apartment buildings, the price per square foot range has actually been in a pretty tight range, between $400 to $600 a foot, well below replacement cost. It was really only the mixed-use asset class, and that's where you see the retail values contributing significantly, that spiked in 2007, where the average price per square foot went over $1,000 a foot, and now it's settled to around $700. As you look at cap rates, in the height of the market in 06-07, walk-ups were trading in the mid to high 4 cap range, with elevators even dipping slightly below 3% at one point. Today, The cap rates have certainly inched up, with walk-ups averaging about 5.5%, with elevators at 5%. Mixed use has been at 6%. You can also see that the multiples have dropped from at the height 17, 18 times rent roll to today between 11 and 13. To look at some of the significant market trends, we saw the Bleecker Street luxury retail portfolio trade. Our company sold this. It had a total of 6 retail tenants: Michael Kors, Marc Jacobs, Burberry, APC, and Mulberry. On above grade square footage, this traded at close to $6,700 a foot on the above grade square footage, which represented a cap rate of 6.35%. According to Reese, this sale marks the 3rd highest price per square foot transaction in the U.S. since it began tracking data. So as we can see, the demand for core assets, especially retail with credit tenants, is exceptionally high. Here it was an institutional buyer who ended up purchasing the property. However, there was a lot of demand from foreign buyers. As far as with multifamily, here was an elevated apartment building that we sold on East 88th Street. It had 150 feet of frontage with 73 units. About half of those were fair market. You can see here the cap was under a 4%, but the price per square foot was only at about $265 a foot. Price per unit was attractive at only over just per unit. Single families in the luxury market performed surprisingly well in 2010. Here was a 65-foot wide townhouse that sold in Tribeca. This was a record price at over $24 million, or close to $2,200 a foot. This was the highest price ever paid. Development sites, as mentioned before, have picked up quite significantly. Here was a trade on the corner of Lexington and 65th Street at over $26 million for $482 a buildable foot. 25 luxury condos will be built. Conversions also, pricing has certainly picked up. Here is a former women's dormitory that the Salvation Army sold for $60 million, or just over $700 a foot, and this will most likely be converted to luxury condos. This property benefited from direct views of Gramercy Park. Just to touch on the outer boroughs, demand there has been very stable. Again, the numbers were down in Queens, but here you can see that this was a 220 unit apartment building that traded for a sub-5 cap, or close to 10 times rent roll. This represented about $187 a foot, or $140,000 a unit. As far as what our company has seen, you can see that the contract execution numbers in the 3rd and 4th quarter of 2010 have been on par with actually the 2nd and 3rd quarter of 2008 before the market correction. So we should have quite a bit of activity in the beginning of this year, 2011. You can also see these have been more significant contracts for us as our pipeline. When you compare it to the 2nd quarter of 2009, not only do we have more contracts being signed, but they are at more than double the value. As far as where our buyers are coming from, in 2009, only 3% of the buyers were foreign. Today, that's more than doubled to 8%. They're coming from all over the world: Asia, Europe. As far as other activity our company has seen, December was the busiest with 35 sales. This was our busiest month for close to 3 years. In 2010, our company sold 284 properties for about $837 million. This was 40% more dollar volume than 2009, but again, only about half the properties that we sold in 2007. The one challenge that we have faced is lack of inventory. In the height of the market, we had 740 listings. Today, we have just less than 500, but we do anticipate that will pick up, seeing how that our special asset assignments have more than doubled from 2009 to. As far as predictions, again, we think we're going to see a lot more activity in 2011 with about 50% more sales. There's going to be larger, more significant sales, as you can see from the 2009 to 2010 comparison for the top 10 sales. I think this trend is going to continue. Cap rates will stabilize for walk-ups, elevators, and core retail in that 4.5, 5.5 cap range for multifamilies, and around a 6 cap for core retail. Development sites will continue to command in the mid 300s and even above for more premium sites. Once again, we do believe that if you have any questions on this presentation, please feel free to call me at 212-696-2500. We look forward to being in touch.